In a world where the stock market crashes, inflation skyrockets, and job cuts loom large, what do? We've seen it all before. Trump's tariffs disrupted the global supply chain, central banks have hiked interest rates to fight rising prices, the economy seems like it's on the brink of collapse, and fear has gripped the world once again. Recession is in the air. But here's the thing. Recessions aren't just moments of destruction, they are opportunities waiting to be seized. Throughout history, those who have had the foresight and strategy have turned these downturns into their biggest financial victories. Let's break down the reality of a recession and learn from the best how to build a resilient, recession-proof portfolio. Recessions are part of the economic cycle, but each one teaches us something vital. The Great Depression of 1929 wasn't just a dark chapter in history, it was a lesson in the resilience of the human spirit and the economy. It took decades to recover, but those who held on to quality stocks and bonds through that period emerged stronger. Fast forward to the dot-com bubble of 2000. New technology and untested startups dominated the scene, but when the bubble burst, it wiped out trillions in value. Yet, the survivors, the investors who bet on solid, profitable companies, came out ahead. Then there was 2008, the global financial crisis. The housing market collapsed, Lehman Brothers fell, and unemployment soared. But during this chaos, investors who stayed calm, like Warren Buffett, continued buying valuable companies at bargain prices. By 2009, Buffett had invested $5 billion in Goldman Sachs at a steep discount, and in just a few years, that investment was worth billions. This pattern, opportunity during adversity, is what makes recessions both a challenge and a chance for wealth building. So, how do the wealthy navigate these turbulent waters? First, they understand that recessions are not a sign of the end, but a recalibration of the market. The rich don't get scared, they get strategic. One of the best examples is Warren Buffett, who famously said, "Be fearful when others are greedy, and greedy when others are fearful." Let's take a look at Buffett's moves during the 2008 financial crisis. While others were running for cover, Buffett saw opportunity. He made massive investments in companies like Goldman Sachs and General Electric when their stock prices were beaten down. These weren't speculative bets. They were investments in companies with solid fundamentals, just temporarily undervalued due to fear and panic. Buffett's strategy is simple. When everyone is scared and selling, he sees bargains. Take Coca-Cola, for example. Buffett bought shares during market dips in the 1980s, holding on to them for decades. While others worried about short-term fluctuations, Buffett's long-term strategy turned out to be highly profitable as Coca-Cola's value grew steadily, rewarding him with both appreciation and dividends. But what about investors who don't have billions to deploy like Buffett? Well, the principles are the same. Whether you're managing 5,000 or 500,000, the strategy of buying quality, undervalued companies and holding them over the long term works. Ray Dalio, the founder of Bridgewater Associates, a $150 billion hedge fund, stresses the importance of understanding market cycles. He explains that no market is always up or always down. They move in cycles. Dalio's success comes from his deep understanding of these cycles and being prepared to act when they turn. In fact, Dalio's pure alpha strategy focuses on making investments that perform well regardless of whether the market is going up or down. Dalio's advice? Diversify, diversify, diversify. And don't just diversify within one asset class. In the face of a recession, he ensures that his investments span across multiple assets, such as stocks, bonds, commodities, and gold. Now, let's dive deeper into how you can apply these principles to build a recession-proof portfolio. 1. Quality investments with strong fundamentals. The wealthy invest in companies with a proven track record of performance and resilience, companies that are necessary no matter the economic climate. Consider Procter & Gamble. Its products like Tide, Pampers, and Gillette are essential regardless of whether the economy is thriving or contracting. These businesses generate stable cash flow, and they're often less affected by recessions than speculative stocks in emerging sectors. In the same vein, companies like McDonald's are recession-resistant because of their affordability and consistent demand. During the 2008 financial crisis, McDonald's saw a surge in sales as consumers turned to more affordable dining options. The stock price rose by over 30% during the recovery, demonstrating the power of investing in recession-resistant companies. 2. Contrarian investing. Contrarian investing is a strategy that involves betting against the crowd. The wealthy know that recessions often create panic selling, which opens the door to buying valuable companies at a steep discount. An example of this strategy is John Paulson, who made billions during a 2008 housing crisis by betting against the housing market. While everyone else was pouring money into real estate, Paulson realized that the housing market was over-leveraged and overpriced. So, he took a contrarian position and profited massively when the bubble burst. 3. Diversification across asset classes. Diversification is essential in building a recession-proof portfolio. Ray Dalio's all-weather portfolio is a great example. This strategy allocates 30% of your portfolio to stocks for growth, 40% to long-term bonds for stability, 20% to commodities like gold for inflation protection, and 10% to cash or short-term bonds for liquidity and security. The beauty of this strategy is that it's designed to perform well regardless of economic conditions. When stocks are down, bonds or gold often perform better. When inflation is high, gold or commodities can protect purchasing power. And when deflation hits, cash and bonds are safe havens. 4. The power of long-term thinking. One of the most powerful strategies employed by the wealthy is long-term investing. They don't try to time the market, they know the market will eventually recover. But it's crucial to select investments that have a proven ability to weather storms. For instance, Apple's stock was volatile during the 2000s, but its long-term growth trajectory was clear. The same applies to Amazon, which had many down years but ultimately became one of the biggest companies in the world. These companies are great examples of businesses that, while they may experience dips during recessions, have enough resilience and market dominance to thrive over decades. So here's a practical strategy you can adopt today: the permanent portfolio pioneered by economist Harry Browne. This strategy is about being prepared for all economic conditions, and it's built to ensure you're protected no matter what happens. Here's how it works. 25% in U.S. stocks. These provide growth potential. Equities are the backbone of your portfolio for long-term wealth creation. Look for large-cap companies with a history of stable profits. Apple, Amazon, and Microsoft are great examples. Historically, U.S. stocks have averaged about 7 to 10% annual returns. 25% in long-term bonds. Bonds become more valuable when interest rates fall, which happens during recessions. Long-term bonds are a safe bet for generating income, especially when central banks cut rates during a recession. Consider treasury bonds, which have been a solid performer during past recessions. 25% in gold. Gold acts as a hedge against inflation, deflation, and currency devaluation. During periods of uncertainty, gold often increases in value as it is viewed as a store of value. In the 1970s, gold saw massive gains during high inflation, and during the 2008 financial crisis, it surged while other assets fell. 25% in cash. Cash doesn't generate a high return, but it offers safety and liquidity. When the market crashes, cash allows you to take advantage of discounted assets, purchasing stocks and real estate at bargain prices. The key here is that it acts as your safety net, allowing you to weather any storm and pounce on opportunities when others are too scared. This portfolio provides balance and resilience. It's not about chasing the latest trends, but about building a foundation that stands the test of time. The reality is, recessions are inevitable, but they're not the end of the world. They're simply a part of the natural economic cycle. By staying calm, thinking long-term, and employing strategies like those used by the wealthy, you can build a portfolio that not only survives, but thrives. Recessions redistribute wealth, but it's those who stay disciplined, who invest in quality, who diversify, and who think strategically that come out ahead. So don't panic, get strategic. The rich follow proven principles to stay secure during tough times. You can too. Subscribe for practical steps to build a stable financial future.